I think today there's a lot of opportunity for private equity investors. What's great about the private equity investors that distinguishes them from earlier investors in the asset class is they have a much longer term investment focus. Early investors in the industry were hurt because they were short-term focused, 1 year, 2 years, and that didn't allow them to be positioned well when the industry collapsed and they were ended up holding these policies. The private equity investors have a long-term focus. They look at the investment as a 3, 5, even 7-year investment strategy. The capital that they have is structured that way, so they are able to call capital. Their investors don't care about 6-month liquidity, 3-month liquidity. They want long-term investments with long-term returns. And what's great about the asset right now is that the kind of assets that are available, these are distressed assets. They are distressed because the sellers are distressed. The assets themselves actually perform. They're basically life insurance policies, which are a series of cash flows. You pay premiums, and insurance companies, most of which are very highly rated, will pay the death benefits. So the opportunity is great to buy really what are quality assets, but from sellers who have run out of liquidity and run out of the ability to maintain these assets. And that's a perfect match for a private equity investor. Well, what's developed in the past 6 months is that the pricing has started to come in a little bit, meaning come down, as competition has increased. So 6 months ago, maybe 9 months ago, there were very few investors and very little capital available for these distressed assets. But as one and then a second and then a third brand name investor came into the asset class, started to deploy capital, it signaled to others in the industry that this is a worthwhile asset, that you can understand it, that you can make money in it, and it's brought a lot of other investment capital into the space, which is good for maturing the industry. From an investment standpoint, it's not as good because it creates competition. Competition brings returns down as people are willing to accept lower and lower returns to get the same assets. It's still a very, very attractive asset, and relative to other investment opportunities, the returns are still great. You're still looking at returns that are north of 20% per annum, which compares very favorably to other investments, but that compares not as favorably to 25 or 30%, which is what we were seeing 6 months ago. The best way to manage expectations is to really focus on the risks and make sure that the investors understand those risks and price those risks accordingly. And one of the biggest risks in this asset class is the risk of longevity, an insured outliving their life expectancy. How long an insured lives, which is at the time at which the death benefit gets paid, is directly related to how profitable the investment is. And so investors need to understand that risk, and they need to price that risk accordingly. And years ago, we didn't, as an industry, have a very good understanding of mortality and longevity. The tables that we had were not accurate, and the information that we had was insufficient to really draw accurate conclusions. We have more data today than we had before, and 5 years from now we'll have even more, but investors know today that they don't know enough, and therefore they can price in that risk and they can be more realistic about what are returns. Do they want to get 20 to 25%? For sure, but they also understand there's a chance they may only get 10 to 15, and that's a big difference today from investors years ago. Private equity really has a tremendous opportunity to shape the life settlement industry right now. One of the biggest problems for the life settlement industry is its immaturity, and in particular the fact that it is so fragmented and misaligned. So you have very different constituencies throughout the process. You have brokers, you have agents, you have providers, you have insureds, you have investors. They all have different agendas, they all have different interests, and they're not aligned. And one of the things that private equity firms do is they see these fragmentations and they see these opportunities in an industry, and they consolidate it and they improve it and they make it more efficient. And so the private equity firms that I work with, and what we're seeing today, is they come in, they see this industry, and they see very undervalued companies, and they see somewhat mismanaged companies, and they see the opportunity to come in, bring these companies together under a unified structure, under one umbrella, create organization, create professionalism, and have companies that are run in a way that they're used to operating, and it will create a much smoother, more efficient process. It will create credibility for the asset class and for the players in the asset class. And it will all do that in a way where the private equity investors can get in cheap today and exit out in a couple of years, usually through either some kind of strategic sale or through a public offering. And it's really the best way to clean up an immature asset class.